Master Trader Live. You're watching Master Trader Live. Simple market analysis and education to help you make money in the markets. Join us live each week on YouTube and see past episodes at Master Trader Live. And now your show hosts, Greg Capra and Dan Gibby.
What's going on here? There we go. Good afternoon, everybody. Welcome. It's Wednesday, and we're going to do another great episode of Master Trader Live. Today, we're going to be talking about how to make money using covered calls. And of course, any and every option trading strategy that we do here at Master Trader revolves around a chart pattern. Without the chart pattern, no option trade. And that's what puts the odds in your favor. Now, when you sell covered calls, which we're going to explain thoroughly, there's the potential to lose the stock. Sometimes you may not care, and at other times you really don't want to. So the timing is essential. And those that just arbitrarily pick a point to say, oh, I think that this has gone too far, and they're going to sell a call option, may not be the result that they want. Typically, we're looking to increase income, reduce costs, and we're going to explain that thoroughly. So if you don't understand what it is, selling covered calls, Dan and I are going to explain that in detail. And of course, we're always talking about chart patterns. So regardless, even if you're not an options trader, what we'll talk about here today will help you in your stock trading, ETF trading, E-mini trading, anything you can chart. So let's do it, Dan.
All right. Welcome, everybody. Sounds great. Yeah, this is actually a very powerful strategy, which is extremely simple. Many people start in trading just buying and selling stocks with the pattern. And all we're going to do today is show you how you can use this one simple option strategy, as the title shows you here. We're going to turbocharge your returns with this. We're going to show you the pros, the cons, how to do it to maximize your profit. And as Greg said, obviously many chart examples. And as always, at around 12:45, we'll do live scanning, looking for not only new trade ideas using this, but where we might consider legging into these covered calls. As Greg says, everything starts with a compelling pattern. And this is our master trader approach. Compelling pattern on multiple time frames. Then we look at the trend. We look at support and resistance. Is it showing relative strength or weakness? And then we calculate position size and enter to position. So when we look at a chart, you're gonna hear Greg and me talking about all these concepts all the time. And then we go to the option market to decide what is the best strategy to meet our objective. Now, Master Trader teaches both what we call directional option strategies, and that means, hey, this is multiple timeframes in alignment, it looks great, and we're going to use options to profit our directional bias. Then we have what we call income strategies, where we're just selling options, where we're collecting that premium, predicting that a stock's not going to break support or go over resistance. So we're not talking about that today. Today, we're talking about one of the directional bullish option strategies. And you'll see why I called it a mildly bullish directional strategy in a moment here. But it's this simple, this strategy. When you buy stock, you're going to make money if it goes up. You're going to lose money if it goes down. We say that has a delta, so to speak, of 1.0 because you're going to win if it goes up and you're going to lose money if it comes down.
Oh, Dan, you option traders just love brain damage. So when you throw that out there, that delta stuff, I'm thinking of faucets, you're thinking of things going up or down, but
I think of an airplane.
Yeah, why think about delta versus up or down? How does an option trader utilize that? I mean, I know we're not going into all the different little details of options, but I'm sure there are people that are listening that are being like, what did he say?
Okay, so let me table the answer to that when we look at a quote screen, and then I think you'll make a little bit more sense there. So all we're doing on this very simple strategy is we're going to simultaneously buy that same bullish stock that the chart pattern is bullish on, and we're going to simultaneously sell an out of the money call contract. And every contract represents 100 shares, so you just got to match the math up on that. Okay, so what does that mean? I'm selling a call. It means we're going to go to the option table, see what the quotes are from selling a call, and as it says here in the third bullet, that's what we're doing. Money is going into our brokerage account, and we are simply agreeing to sell in the future that stock that we just bought at an agreed upon price on or before expiration. So you might think, well, why would somebody, you might think two things. Why am I agreeing to sell my stock that I just bought? And you might be thinking, why would somebody give me money? And that's what a call option is. People go to the option markets to speculate on direction. The money is 100% yours. As soon as you sell that call option, you have an obligation to deliver, but it's your money. It's in your account. So what it does is whatever stock you're buying, the premium that you're taking in at the same time is lowering your cost basis. And that's why we say that this produces a higher probability of profit by definition. Probability of profit. It doesn't mean total profit. Probability of profit means, since I'm lowering my cost basis, I have a defined edge over buying, because whether I close it out, if the stock goes against me or is flat or goes up, I have a higher percent probability that I am going to close the trade with profit. That's what that means. When people buy call options, they have time decay. It's like a melting ice cube. So we are going to sell that call option to them, just agreeing to let them take our merchandise. This last bullet here is why I call this a mildly bullish directional trade instead of, let's just call it fully bullish. We are agreeing to sell our stock at the agreed upon strike price. But as Greg said in the introduction, hey, what if I don't want to sell my stock there? You're capping your gains there, but we have adjustment strategies for that also.
So Dan, before you continue,
Sure.
without knowing the other person that's on the other side of the trade, of course
Okay.
you don't, why would you speculate that they'd be willing to give you that money for that call option?
It's not a speculation, it's a fact. In that,
No, but they have a reason. Everything in the market's based on some speculation of making money.
right?
So you're willing to sell something and they're willing to give you the money for it.
That's correct.
So what do you speculate their thinking is, that they're willing to give you that money and they're going to make money?
It's not a speculation, it's a fact. They are buying it on the speculation, because it's when you buy an option, that's a bullish option strategy. So they are buying it with the expectation that that stock is going to go up.
And you're not?
That's why I call it mildly. So once we work through these numbers, you'll see that this is just a little option table for these couple of strike prices here. So let's go through them. And as you know, and we're educating our traders today, we only agree to sell our merchandise there if the chart is stalling there, or if we look at the math and we say, heck yeah, I'll take that amount of money and agree to sell my stock at this. So let's work through these numbers. I have a lot of examples, obviously. So this, and I don't even tell you what stock this is. It doesn't matter. So it's kind of a retested major support, bullish gap, and it really performed much more than the chart pattern suggested. But so let me ask you, Greg, would you call this entry at the arrow, would you, using master trader strategies, label that a fully bullish pattern or a mildly bullish one?
Slightly mild.
Right.
Meaning if you said, Greg, look at XYZ, my expectation of Dan would be telling me, let's sell a put spread.
That's absolutely correct too. But I'm also answering your question from the prior slide, which was these are real option quotes. So let me explain what they are. So February 7 expiration, the stock, let's just say we're buying it right here at $115.
So I put the little green box down to kind of like,
okay, perfect.
Price scales there.
Okay. So if I have it up here in the first bullet. If we buy the stock at 115.05 and you stop right there, then you have a directional stock trade on your hands. But now if I simultaneously say, you know what? Look at this 125 where Greg has a second box up here, and I go to the option table and I can sell it on the bid for $1.54 a share. Well, I said 155, getting a penny price improvement. That is lowering my cost basis to 113.50. So you have to ask yourself, based on the pattern that we just talked about, which Greg and I are in agreement of, it's mildly bullish. Would you be happy with selling this pattern, Greg, at this $125 strike price? You would say that's a home run. Of course I'll take it. And I lowered my cost basis $1.55 a share.
Yeah, and that was, I'm just kind of looking at the chart there. That was what, 2 months out from the entry, or month and a half?
It'd be, let's just call it 30 days. Yeah, I didn't put I mean, we could count.
I'm just eyeballing,
Right.
to there.
Right, January to, so call it 40 days, sure.
Absolutely.
Right, so I hope we're slowly, for our listeners, and we have many more slides to go, but this is the starting point. So we're capping our gains at the 125 in return for selling it at that strike price and reducing the price of the stock. So since we reduced our purchase price, our cost basis, that increased the probability of profit, because the stock could go against us. The amount of this $1.55 premium that we put in our pocket, it can go against us before we start losing money, that amount. Let's continue. So now, I gave you 4 different strikes, expirations. These are the considerations that we go through. You want to select the strike price where we're the call seller, we bought the stock and we're selling the call, that we're agreeing to sell it at if the buyer wants to take our merchandise at that price. We just showed you $125. Let them have it. Let them have it at 125. I put $1.55 in my pocket. The further away that you are saying that you'll sell your merchandise for, so here's the 130, the less money you're going to get, of course. So you have to juggle with the pattern of how much upside you really think it has. And as I admitted, I didn't expect that big move.
So Dan,
Sure.
Go back to that slide. We may not get to all your slides here, because it's interesting to me. So I'm thinking, all right, here it is, and I'm going to buy the stock at $1.1505. Well, I'm looking at the 115, and I can put $5.20 in my pocket.
Exactly right.
And I'm looking at that pattern, and I wouldn't have thought it went up like it did.
And then
and I'm thinking to myself, well, I'll just bank $5 right now, and if it goes up, who cares?
Exactly correct. That's exactly correct. And then the 115.05 minus 5.25, you're reducing your cost basis to $109.80, if I did the math right. So that's correct. That would be, and then you're agreeing to sell it at expiration at 115. Let them have it. And you obviously know this in the green trading room, and for our subscribers of the advisory letter, I say that in the telegram at a whatever strike, that if it's had a good run, I'll say let them take it. Let it at expiration day. Let them have it. I'm happy. We made a big gain.
Those options, when it goes up there, are going to be worth a lot more.
Right. And that goes back to the other comment of the only downside on planet Earth of this strategy is capping your gains. Otherwise, whatever brokerage account you go to, whatever course you go to on trading options, the SEC, everybody is in agreement that this is a marvelous, simple, high probability option trade. Many people say, oh no, options, you're going to blow up your account. They're dangerous. There's so many stupid myths out there, as you know, which you and I demystify all the time with facts and education. But everyone's in agreement that this is a wonderful low risk strategy. You can do it in your IRA account. You can do it in any accounts. The SEC doesn't care.
So Dan, it is going up in that direction. Correct me if I'm wrong, but in a sense, you do have some type of handcuffs on, because you can't really sell your stock and leave yourself exposed to that option.
Well, so Debbie is going to change her drop down, but that's a question Debbie's asking right now. She says, hey, Dan, if the stock goes against you, are you going to stop out of both positions? It depends if you want to trade the chart. And all our subscribers know we take stop losses. So this is not, you can still stop out of these at a loss if that prior example, if this thing gapped down $5, of course I'm going to be holding a loss, but I'm going to be holding a loss less than if you were just an owner of the stock.
Well,
So
in a sense, that gap down $5, that option is still going to have some value, but it's going to be almost worthless.
correct. And that's why we have a higher probability of profit with this strategy. Correct.
So, I mean, you could close the option and maybe even make a few dollars because of what you took in, depending on how much it gapped down. But if it's going up, let's say, it's at 124, and you say, I'd like to sell that and bank the profit of the equity, but now that option is worth more money. And you can't just, now you can't leave yourself exposed not having the stock to turn in. So in a sense,
Correct.
at some point you can't sell the stock
Right.
without covering the option, because then you could have a real problem.
Right. And work chartists. So Debbie, the answer to the question is 99% of the time we're going to close both. But and now to Greg's point, if I wanted to leg out of the position with the charts, yes, we do that. We teach it in the full options course, but that's a more advanced strategy. But that's called legging in and out. Yes.
Okay.
All right, let's continue. So the longer dated call option, the more money you're going to get. And I'm just telling you here the sweet spot, 7 to 30. But I should have changed this to 1 day to 30, because if it's on a Thursday and I pull up those option quotes and I say, wow, I can get $1.50 for selling an out of the money call option for 1 day. And then I do the math on how much return on capital that premium is, sure, I'll do it. Some people just routinely sell call options on their long-term holdings, just as a matter of course. Some do it methodically. We do it with the charts, but it's a fantastic long-term strategy, folks. It really is. Well, it applies to all time frames. I said long-term. but it is wonderful for swing trading too. And depending on which strike and expiration you take, there's going to be the trade-off in time decay, max gain, and the return on capital. I'll show you many more examples right now. OIH, so this was just a day or two ago. Let's say, so Greg, here's another kind of question. I would label this mildly bullish, not fully bullish pattern because of all this resistance to the left, but it had a nice breakout, it's chopping around. And now let's go to the option table and see what I can get paid. Let's say I'm going to buy the stock just right here, 132 bucks and change. So these are the 25-day to expiration out of the money calls. Let's just take a look at these like we're in a candy store and see what we can get paid. So Greg, similar to your other example, when you said, hey, I can sell the 155 bucks and 20 cents. These at the money, the 132s, you can do the same thing here if you want. You can sell the at the money 132s for, I don't know, 815, 820. And as long as the stock, Greg, just goes sideways or up, you have made over $8 a share in 25 days.
That one's very attractive.
Okay, so let's now go further out of the money, which is agreeing to go to we're agreeing to sell our merchandise at higher prices. And folks, I mean, when we talk about call options, just think about it like a house that your neighbor comes knocking on your door and says, hey, Greg, will you, we're thinking about moving here, whatever. Will you give me will you give me the right to buy your house at, $1 million within the next 30 days? And you say, sure, what are you going to give me for it? I'll give you $20,000 for that right. This is the same thing. It's a strike price, agree to sell at an agreed upon price and expiration. So this one, I like the 145s because they're very liquid. This is the oil services ETF, and they did some reverse splits, which is making it much more not as liquid as I prefer. And so you need to focus on the high open interest ones. So just ask yourself, Greg, if we're going to put on this mildly bullish directional option trade, we buy the stock, we're agreeing to sell it where you have your green line here, way the heck up here at 145. If I'm assigned, which means it closes above 145, look at the math here. Then I've made $9.73 a share, 7.5% in 25 days.
Based on the money you took in.
Partially because the stock went up, of course, but we took in $3.15 a share extra. So that reduced our cost basis 2.4%. That's our built-in hedge. So this stock can go 2.4% against me. And that's my break even. Now, what I'm going to show you is if you've started with a fully bullish position in your stock, when momentum stalls and you still want to keep the underlying, so you got to keep that in your head too. If you're just swing trading stock or options and you enter here and it goes up 5 bars to your target, just get out and you're on to the next trade. So we do this when we still want to keep the underlying, but momentum has slowed and we want to lower our cost basis. We want to put some money in our pocket. So these are all just pictures of slowing momentum using the charts. So what we want to do, you see my red lines, you want to go to the option table and pick any strike you want based on the considerations that we just reviewed. That money is going right into your account. In exchange, you're agreeing to sell your merchandise that we just reviewed. This is one that we were in our swing and options trader. We do these all the time. Our swing and options trader, we trade stocks, options, directional, income, covered calls. We do everything in here. So we bought stock on this breakout. Beautiful, beautiful. This is a gold stock. We've been nailing this sector, gold and silver. Beautiful 180 reversal here, Doc. And it had 1, 2, 3, 4 bars, topping tail, inside bar. And we said, all right, slowing momentum. I still want to keep the stock, but what's wrong with lowering our cost basis? So we sold the $52 strike right there. We took in, and this is 8 days to expiration. If we had more time, I'd give you a quiz to say how much did we reduce our cost basis. So let's just say we sold it for $1.65. Then you would divide $1.65 by your cost basis, and I've just improved my cost basis in 8 days. So the only downside that we've talked about is, what if your merchandise gets taken away from you in 8 days at $52? Well, I've made an additional $1.65 in 8 days. Let them have it. Let them have it. It's a marvelous return. And just so I don't forget though, just because you sell an option, if the chart then goes from slowing momentum back to bullish, you can come to the marketplace and close that short call. So it's like Greg ripping up the contract to sell his house. You rip it up and you got to pay a fee to get rid of it. And that's going to the marketplace and closing it.
Yeah, and look at Mark's question on Delta.
For directional delta of 7, yeah, I think Mark's talking about a bull called debit spread. So Mark, if you're long an in the money 70 delta, yeah, everything we're talking about here applies equally to spreads. You know, we're not talking about that today, but very simple. One of our option strategies is, instead of buying stock, we buy an in the money call option, and we do the same thing we're talking about today, which is legging into a bull call debit spread.
So Dan, his question interests me as it relates to this strategy, in that I don't think Delta makes any difference. Whereas if I'm willing to sell something even at the price, at the money that I bought this stock from,
Correct.
to take in more money, what do I care about the delta? Or if I think it'll go up and I want to sell one at a higher price,
Correct.
you know, that okay, if it goes up there, I'm fine with it. What do I care about the delta?
You 100% you don't. It's for the mechanical traders who might be running a covered call, hedge fund or ETF, and they just might mechanically say, you know what, at expiration day, I don't care what the chart looks like, because they're not chartists like you and I are. And they might just mechanically say, I'm selling out of the money 30 deltas, because it's a nice compromise of, I'm still going to make more money if the stock moves in my direction, but I'm still putting some money in my pocket, in my cost basis. But you're right, you and I don't, because we make our decisions off the charts. A couple more examples here. But again, you got to keep in mind that you want to own the underlying. Whoop. So this ugly reversal, these were the out of the money calls. And, we don't have to work through it, but I just showed you the 1600s here. So we're agreeing to let somebody buy our stock at 1,600 bucks after this ugly bar. And we reduce our cost basis 1.2% annualized. And as Greg said, you can either get out of the trade You can do a tighter call spread to take in more money. Another one, breakout failure. So if I were just swing trading this pattern, I would be out of the trade. I wouldn't sit through this. So that's why I keep emphasizing that this is only a strategy if you want to keep the underlying. So this one, breakout failure, I'm saying, you know what? I'm going to over the high here. I'll agree of it going against you. Here, same kind of example, but showing you a bigger chart here with a rising 20, 50, and 200. Had a breakout failure here at this arrow, big, ugly engulfing bar. Here's the math. We're selling the way out of the money, 340 calls for almost $6, 2% for 24. So this one was actually, Greg and I do some consulting for family offices, high net worth individuals. So Greg and I wouldn't be sitting in, either one of these three trades based upon the pattern breaking down. But if one of our subscribers say, look, I'm in this for the long haul. Can you all help me use your chart analysis and option strategies to tell me when to sell calls? That's exactly what we do here. And it improves their cost basis. Old Tilray here, marijuana stock, broke out here. So we gave this as a long right on this breakout. All right, Mark, so if I'm not answering everything, feel free to email me, or we can look at a real example here when we pull up the charts. So this is a good example of saying, look, we still wanted to be in the stock, but something happened where momentum slowed, and let's go see how much we can get paid to increase to improve our cost basis. So here's what we gave our subscribers. We bought the stock here, a bullish breakout, pulled back to support. Here's my adjustment. We bought the stock, there's my stop. We're going to short the out of the money $7.50 calls for, it's 9 days away, putting in 45 cents a share, lowering my cost basis from 681 to 636. And you might say, well, that doesn't sound like a lot of money. Well, let's do the math. Pretend you had 1,000 shares of this. Selling a 10 lot, $450 are going into your account. But let's look the math on a per share basis. The 45 cents a share that I'm taking in, selling a covered call, divided by my stock price, folks, that's 6.6% return in 9 days. So it's a nice hedge when the stock is just going sideways in a coma. Greg, remind me, we'll show them Target, TGT, because that's one we're in right now with our subscribers. We bought a breakout. It's in a coma, and same example of this, where we're making money, even though the underlying is not making you money. It's in a coma. This is just showing you, I did this example. I think this, believe it or not, was United Airlines before the Corona problem hit the whole sector. But this is just showing you the math that if you do this regularly with the charts, you can really, we have some people that they have got their cost basis on long-term holdings below zero. What's your reaction to that? You might think, yeah, right, these are snake oil salespeople. No, let's look at it. So let's say we bought here, momentum actually slowed here. This would have been a time to sell calls actually right there, but stalling here. So here's my debit. We're selling the $78 out of the money calls, 28 days to expiration, taking in $1,420. That's my new adjusted basis. At B here, doing it again. Selling 30 $78 calls. There's my new cost basis. In 2 months, we lowered it 5.8%. And you just do this over and over and over again. Now, we've been talking about covered calls the whole time. I'm just showing you this one example, and this is called a covered put. Identical analysis of everything we've been talking about so far, but it's on a pattern where you have a bearish bias. So this was Norwegian cruise line. The cruise lines and airlines through this corona have been, bearish. This was a ugly breakout failure. So let's say you wanted to short the stock. So you shorted the stock, that's step one, and you simultaneously are selling an out of the money put. So this was a couple days ago, 8 days to expiration. You come to the table and you say, okay, what strike price would I mind having to buy the stock? And you say, wait a minute, what do you mean buy the stock? Well, I'm short the stock. So by me agreeing to buy it, my position goes away, similar to the covered call, where if I'm forced to sell my merchandise, the position goes away. So if I shorted, I just picked this $14 one here. If I shorted the $14 puts for 50 cents a share, it increases my basis because I'm short stock to 15.16, 3.4% improvement in 8 days. So identical to covered call on the put side. That's called a covered put. Just some other considerations here before we wrap up and look at real charts. As option sellers, ideally we want the call option that we are selling to expire worthless within 1 penny, because that means we nailed the strike price and we made 100% of the premium that the buyers lost money. As Greg said, hey, if I'm happy with the return and I don't mind being assigned, then do nothing. So that's the Greg bullet right there. If you're a more active trader, as I mentioned, you can close out the call if the chart pattern turns more bullish. Even if you had to close out the call at a loss, it's not a net loss, folks, because the gain on your long stock, by definition, is greater than the loss that you might or might not have to take on closing the short call. Tying how active you want to be is just going to depend on if it's a swing trade or position trade. And one thing just to warn you about, if you're doing this on longer term holdings that you might have been holding for years or decades, talk with your CPA, because I don't want you to have your stock disappear against your knowledge, and then all of a sudden you got a big tax problem on your hands. So check that out if you have an issue with selling your long-term holdings. All right, so we've shown you a number of real trades in our, we call it the all-inclusive advisory Market Edge membership. It comes with our advisory letter where we trade stocks, options, directional income. We have the alerts, intraday, we have a market review, Facebook group, all this. And many people subscribe to the annual. It's $697 because that's 40% discount. And Greg and I decided to give you a bonus today. We're going to take that same annual and use this code here, MT Market Edge, and we're going to take off another $200 from the annual, so $497. because we want you to, to learn with a detailed market review with these trades. This Telegram text messaging is priceless. How we not only give new trades, but the trade adjustments. And as you
Did you give a
know,
link, Dan, to the page? I didn't miss to this page.
no, let me get it right now. It's just, yeah, it's just the annual.
I can get it, but
Okay.
then they get to the site and then it's like,
Yeah. Yeah, no, I didn't put it on here, but thanks for reminding me. All right, so this is the swing trading course, Greg's amazing course that teaches you how to objectively trade anything that moves. He puts everything together in these thought building modules. You hear how when we look at a chart, all the concepts that we talked about on page 1, that's what you learned in this course. The patterns, the messages of the bar, support, resistance, trends, everything. So as an additional bonus, when you check out, if you buy that annual at the extra 20 whatever percent off, these are just add-ons at additional big discounts. You can buy that same swing course right here. Click it here. We'll give you another 20% off of that. And then Greg's AMS, which is Advanced Management Strategies. If you want that, 50% off. It's amazing how many people don't focus on management and proper positioning sizing instead of just, hey, that's a great chart. Let me hit the mouse and get in. So that's critical to long-term success is proper management. So that's all I have, Greg. It's perfect timing to look at the markets now.
Always perfect timing to look at the markets and stocks.
Exactly.
Oh, I have an alert on Walmart going down, which was a possible short. I'll get to that later. Anyway, so Dan.
Well, why don't you show them target before you ask that question? Because we're in this one.
Right.
So point to them where we bought the breakout. And then the same day that we entered, because of the tail, we sold an out of the money call. So we're actually up money now, even though we're flat from where we entered it, the stock. We're up money because of the call we sold.
It was on this day.
Right.
It came back in. And what was the strike of the call?
Out of the money. I don't know. I'd have to look it up.
Okay.
Above the bar's high.
Well, there's a lot of room above the bar's high. That's why it was bought.
Right. So that's it. Just wanted to highlight another example that we're in right now. That
When did it expire?
tomorrow or Friday, rather.
Okay, well, I don't know what strike it is, but here's the strikes right here.
126. Now that I can see your numbers, 126.
Okay. So, let's see. It's probably here. So you sold it for more than it's worth right now.
Correct. So that's why we're profitable. All right.
Okay. All right. Next one.
I don't have any. So if folks want to have any ideas, or we can just scan and say this would be a good covered call candidate, whether to put it on at the opening trade, or this is where you could leg into a covered call. Yeah, those are kind of the main discussions today.
So Dan, you talked about selling a covered put.
Right.
What if I short Walmart? What would I do to have a covered put?
Well, okay, well, let's go through our mental checklist. Are you okay with capping your gains, or would you want just to do a full either day trade or swing short? You got to answer that first.
Swing short.
Okay, swing short. And it's the top one is your daily. Are you okay with capping your gains? So let's go out to 9 days to expiration and let's see what we can get paid for the 127, 128 puts. And then you and I will say, yeah, we like that premium, or no, I don't want to cap my gains.
So 127's $1.12 by $1.17.
Okay, so if you shorted it at 130.35 right now, that amount, let's just call it 120, 120 will be added to your 130.35, and that's your new cost basis, right? Remember, when we're short, the higher the cost basis, the better. So if you then get assigned 27, are you with that swing trade gains? Because you would make $3.35 on your short, and you'd make an extra $1.20 on the short put.
Yeah.
There you go. So we've just walked through one that works.
And so even if this was to have some bullish reversal back up, I'm going to make money on selling those puts.
Correct, but you'll take a loss if you stop out. If your stop is yesterday's high,
Right.
you will take a loss on that. But you're correct. Our loss is going to be less than if you just shorted the stock alone, because
Right.
what we've been saying, we're increasing the probability of profit.
Right. And you picked 127, but I could do a 130.
You exactly right.
Okay. I'm asking the questions kind of like to
Sure.
bring Dan out to say something else. Maybe you guys are thinking that, but
Right.
not knowing what to ask, if you have different charts. So I'm
Right.
trying to bring up here something to help everybody to understand this concept. Someone's asked about GDX for a covered call. Which makes sense. That ran up. I don't know what they're worth.
But remember, it has to be mildly bullish. Or do you really want to buy GDX stock right here?
Well, we got our subscribers in it much lower.
Right. So, right.
So, it would make sense to do that. Especially, so I don't know that there's any premium there, very little, but it's expiring in 2 days. To say, well, you could take my stock away from me at $44 if it would spring back up and close above there on Friday.
That's exactly correct. And that would be an example, like I referenced about, I sent out a telegram saying, let them have it. We bought that at roughly $36. I'm looking on the breakout. So we had a swing trade 36 to 44, put an extra 44 cents a share in our pocket for 2.5 days. Let them have it.
Right. Not buying here. So I am long from someone that's typing in there saying they're long from below $30. So it's your decision what you want to do. Right. So expiring in 2 days, will it go above $44? It might, but if you go to 45, is it really worth it? But if you go out,
But what I would do on that, Greg, is still sell the 44s for 2 days. And if it then trades over the red bar's high, is you just buy that call back and then roll it to next week. That's called, the industry calls it rolling up and out. So up would mean higher strike price. So maybe sell the 45s or the 46s. And out means out in time. So you could do it for next Friday, the Friday after that. It's back to the slide we talked about of considerations in selecting strike and expiration.
So you have a lot of choices, and so with more time you get more money, but you have more exposure. But, as far as a covered call goes, just your exposure is that, it's in an uptrend. It really could go up to $44. And it wouldn't be a surprise even if it was to do it by Friday with this trend. But, it is a little extended and it's coming in. So, that really becomes a choice, and then you can say, well, if I go out 9 days and I can sell a 46, well, that's like 35 cents.
Right.
Right. So, 9 days, but now saying 40, what's it likely to get 46? So it's like a guessing game where you look,
Right.
but the chart helps versus, say Vega, this, that, whatever. Oh my God. Look at the chart. Look to the left, and bring up a weekly chart and just say, hey, that's pretty extended. It looks like a measure 45. I don't think that's going to $46 in 9 days with that
Right.
chart.
Right.
Right? So, we look at that and say, oh, is there any real resistance there? Not a lot, but it's had a heck of a move.
All right. There's definite time to be selling calls on these positions. I agree.
So, it's an educated guess, which is all technical trading is. Your level of education is a key factor as to, well, is your education based on, the square of 9 and planetary alignments and Elliott wave, or is it based on simple technical analysis, looking at the chart and looking to the left? We think it's the latter. And, it works. Let's see what else Anonymous is saying over here. After 6 weekly green bars and a red bar this week so far, it's not likely to take 44. Well, yeah, I would say the odds are it's not likely to go to 44 by Friday, but I wouldn't be surprised to see it do that as opposed to, say, 46. Keys. What was that about keys? That is, I don't know anything about, covered calls. I mean, unless you were in this long and thought, well, that looks like it's going to go down, so, and I don't want to sell it, and you say, well, let me go to the options table. These are monthlies.
Right. But see, Greg, I think I'm talking for you, but you're kind of answering a question that you don't know the question. So that's what Greg and I always ask people in the green room. Tell me your bias. Tell me what you're thinking before I start talking about things. So everything starts with a bias. Are you in this? Are you looking to short it, to buy it? What's your bias on this? To
Our
us,
conversations about covered calls, which led me to think he owns the stock and now he's in trouble.
okay.
you know so how do I lower my cost a little bit and hope it doesn't really tank, because
I
either
would
way you're losing.
I would do a 9 day. I would do a 9 day short the call over yesterday's high.
Well, you don't have any 9 days because they're monthlies. You have to go 23 days,
There you have it.
and you could do even say $100, or depending on where your cost is, because everybody's always thinking, I don't want to lose any money, break even. Well, if you own it from 105, when you're down $10, the likelihood of selling something up here and lowering your cost, it's not going to happen. You go to 105, 70 cents. It's probably you can get $1 or 95 cents. So you could lower your cost a little bit, but it's not enough to cover that.
Right.
So here's one that it's a better example for thinking to sell a covered call.
Agree.
Had a nice run. The momentum is stalling. It's just going sideways. There's really nothing wrong with it if you own it thinking long term. You got a bottoming tail, topping tail, a red bar ignored. This day's not over. So wouldn't be a bad idea. These are monthlies as well. 23 days is the best you're going to be able to do. And not a bad idea for 23 days. You said
I
you
agree.
sold it at 200. You could take in $5.75.
That to me sounds like it's earnings, which it is 8.3, because that's really big premium.
Yeah. So, you're still lowering your cost by $5 and almost $6.
I would do it.
Yeah, and if it goes up,
Let them have it.
let them have it.
Right.
And if it goes down, you're protected to some extent. And
Right.
if you sold that, you probably, Dan, I don't know what you call this. Again, you option guys have fancy names for stuff, but if I sold this for $5, maybe I could buy some cheap put with that money.
Well, with earnings, it's not going to
Yeah,
be cheap.
yeah, it's not going to be cheap. Anyway, so lots of different ideas that you could start to become creative, with these options and different strategies. But you're getting the idea here of when does it make sense. So you had earnings, it's had a run up. You'd say it's a little extended here on the weekly. It's easily pop, but
And then Greg, as you know, on all of our, Master Trader, as a general rule, we don't like holding into earnings because we don't want the gap risk unless it's a core trade, which means holding period weeks to months, and there's no way around it. But what we do in every single case is what Greg's talking about with said G here. We sell out of the money expensive calls as our objective, common sense way of lowering the cost basis and helping out if it does gap against us.
Derek's asking about Tesla. I have a decent position in, but I'm never sure if I should cap gains since it moves so much. Well, if you knew it wasn't going to go up anymore, but we don't know that, we can only look at the chart and say, hey, common sense, does this look like it's going to make another $500-600 move? And based on what it's doing here now, I would say probably not.
Right.
You got a topping tail, big red one, a gap reversal. So there's distribution going on. There's no doubt it's not collapsing. So if you said, okay, $1,800, what's it worth?
I would do 1700s to get paid more myself, but that's backed again to your own trading plan and personality.
Right. So thinking about time-wise for 2 days, is it going to go to 1,700 in 2 days?
I don't think so.
I'll say no. Right? And I could take in $1.92, and so that's the trade-off. Right? $1,700 for 2 days. You can lower your cost by almost $2. By going out 9 days with more exposure to that and looking at that and saying, well, what's that worth? Whoa, that's worth $15.
These high volatility beta stocks, that's why we recommend doing it all the time.
So there you go. So that's it, folks. There's lots of ways to make money and different strategies using options, and this is one of them. And even if you're not a long-term investor, there are ways to utilize the strategy of covered calls, as Dan showed you. And so you go to the options table, you look at the chart, you look at where support resistance was to the left, how far has it moved up or down, so on and so forth, and you make your educated guess as to what might happen, because in reality, nobody knows. And so you manage your risk in a simple way. So that's how we do it. And hope you've enjoyed that and learned a lot. And we will be back next Wednesday with another topic. And share the channel, tell everybody about Master Trader, and get the letter. We'll be doing more of these. Bye-bye.
Good trading. I'll see you back in the green room.
Thank you for listening to Master Trader Live. If you liked the show, we invite you to share this video on your timeline or tag a friend who wants to learn stock market tips. Stay educated with our free chart of the week, a weekly analysis or lesson sent right to your inbox. We're live every week, and you can subscribe to the channel and press the bell to get alerts. If you've enjoyed the event, please give us a thumbs up. Just visit mastertrader.com. That's mastertrader.com.